Time for Business. Kate Moody's joined us. Germany has issued a warning about its supplies of natural gas because, of course, of a standoff with Vladimir Putin.
Well, last week, Mark, you'll remember that Russia said that countries which have imposed sanctions on it, like Germany and other Eurozone nations, would have to begin paying for natural gas imports in roubles as of Thursday. Germany had refused, describing it as a breach of contract. Putin backtracked on that demand with just hours to go before the deadline, saying he would allow payments to continue in euros for now. But German officials are still urging households and businesses to reduce their energy consumption as they seek to diversify their suppliers. Monty Francis reports.
Russian gas accounted for more than half of Germany's gas imports last year. That fact, coupled with the war in Ukraine, prompted the minister of Europe's largest economy to issue an early warning that it could be heading for a gas supply emergency, all the while trying to strike a reassuring tone.
It is important to emphasize that security of supply is guaranteed, that all contracts are being fulfilled, and that gas and oil are arriving in Germany as planned.
Germany's early warning is the first of 3 levels and includes the formation of a crisis team to monitor imports and storage. Only at the 3rd emergency level would the government intervene in the market to ration and divide up limited supplies. Moscow had threatened to cut off gas deliveries unless it was paid in rubles, something EU countries and the G7 had flatly rejected. Late Wednesday, Vladimir Putin said he would continue accepting euros for now.
We do that in 2.
Government officials say it's another sign that Germany must end its dependence on Russian energy sources, and soon.
We are very dependent on gas, on oil, on coal from Russia, and we want to phase out that as soon as possible.
But for now, Germany remains reliant on Russia. Its reserves are at 25% of capacity, and the economy minister warns that a stop to deliveries from Russia would have serious consequences. In the meantime, he's asking the German public to conserve energy where they can.
Let's check in on the day's trading action now. Wall Street has closed lower. The tech-heavy Nasdaq down more than 1% at the close. The S&P 500 about half a percentage point. We saw oil prices rising again as the U.S. and allies warned that more sanctions against Russia are likely, and that could impact global oil supplies. We saw the international benchmark Brent crude back up around $113 per barrel. A mixed close for the major European indices earlier. The CAC 40 losing 0.75 of a percentage point in Paris. The DAX about 1.5 in Frankfurt. Consumer prices rose by 7.6% in Germany in March and 9.8% in Spain, the highest levels of inflation in around 4 decades. In both countries, that was driven by the soaring prices of food, fuel, and electricity. Earlier this week, the Spanish government announced a €16 billion plan to help households and companies deal with those soaring prices. Brian Quinn explains.
Rising prices and rising discontent. Spain is in the midst of its worst bout of inflation since 1985. Consumer prices for the month of March up 9.8% compared to a year earlier. February's inflation figure was already at 7.6%. At its core, soaring energy costs, which have been on the rise since last year. In the wake of Russia's invasion of Ukraine, though, oil and gas prices have spiked further, as has the cost of food. Under pressure, Prime Minister Pedro Sánchez is taking action.
Our plan is for €6 billion of investment by June the 30th via direct aid and tax cuts, along with the more than €10 billion in loans to soften the consequences of this crisis on families, businesses and the most vulnerable organizations.
That €16 billion plan includes a 20-cent per litre discount at the fuel pump, a €362 million package for the agriculture sector, €68 million for fishermen, and a cap on rent increases of 2% over the next 3 months. With advanced liquid natural gas facilities and an already high proportion of renewable energy, Spain and Portugal are less dependent on Russian gas than many EU member states, but they're also far less connected to the continent's energy grid. That reality convinced EU leaders on Friday to allow an Iberian exception to the bloc's electricity pricing rules. The two countries are expected to announce a special proposal in the coming days to cap gas prices in a bid to bring down skyrocketing electricity costs.
Mark, that's all the business news for now.
Kate, as ever, thank you very much indeed. Always a pleasure to see you. Kate Moody shedding all the light on the business issues for us, as ever. Thank you very much indeed.